Hello, and welcome to With Wellner Anderson. Today, we're going to take a little bit of a change when it comes to the video conference or the video essay. We're going to be talking about the probability or possibility of inflation. Of recession coming down the line. And in order to do that, I think you need to know why I took interest in this. I used to take the bus into New York City. I would buy a newspaper, I would read the articles, and I really wouldn't understand what they were trying to say. I'd be looking at CNBC, I'd be looking at news networks, and I couldn't really understand the politics. I decided I needed to do the thinking myself, so I did the research. And you can do it too. And sort of put it this way, if you had a diagnosis from a doctor that you had a terminal disease, you would go off Google and get a secondary opinion. There's no reason why you shouldn't do that when it comes to politics, economics, and money. Well, let's get started. What is recession? Recession is 2 consecutive quarters of a reduction in gross domestic product. Gross domestic product basically is the number of the goods and services which a country produces. That's what gross domestic product is. There's an economic formula for that, but we're not going to go into that for obvious reasons. So what are the signs of recession? Well, there are low wages, bankruptcies, low business investment, unemployment may rise, there may be problems with layoffs, reductions of hours for employees, consumers quit buying, the stock market decreases, volatility, which we're going to discuss in a minute, slows down, and basically people start holding on to their cash, invest in bonds, and take money out of the stock market. We're going to talk about stagflation in another video, but that's sort of the beginning before you get there. Okay? So, we're going to talk about a couple of tools which the economists use in order to see whether recession is underway. One of them is called the federal funds rate. This is the rate the banks charge their best customers, which is other banks. To make it simple, at the end of the day, when a bank opens for business, they have to have enough reserves in order to pay people that come in for their money, and it's a government requirement that they have these reserves. Let me give you some dates. 4/21, the amount of reserves which the bank lends another bank, their best customer, was 0.25. 4/22, a year later, it had gone up to 0.50. That's 100% increase. That's not a good thing. Another tool that economists use is the stock market. It's a daily figure. We're going to take the Standard & Poor's 500 because it's the most generous of all the stocks. The date, 4/13/22, and the other date is 4/14/21. On the first date, 4/13/22, the S&P closed at 4,407. The second date, which was a year before, it closed at 4,141. So in that event, the market did go up in those years. Another tool the economists use is called PMI, and that's the Purchasing Managers Index. It's managed by the Institute of Supply Management. Now, who are they? Who is PMI? Who is the Institute of Supply Management? Their goal is to canvass 400 companies in America and see what their patterns are for the next quarter. In other words, they'll ask them whether they're going to hire people, whether they're going to build more products, what do the imports look like, what does expansion look like. And from that measurement, the economists can figure out what is being planned for people to buy in the next quarter. Obviously, if that's going down, that could be a key to recession. Dates. 3/22, the metric was 57.1. It's not important you understand the metric. But 2/22, the metric was 58.6. So the difference is 1.5%, which means that the purchasing managers don't feel as confident this month as they did last month. That's a bad sign. We're also going to talk about velocity of money. I don't have the figures, but that's an important tool, because if velocity of money is moving fast through the economy, that's a good thing. If it slows down, that means people are putting money in banks. That's a bad thing. Now, the most common thing you probably heard of is called the yield curve. The yield curve measures treasury notes, treasury bills, and treasury bonds. Put it this way. The longest you can invest in a treasury bond will be 30 years. And the shortest can be up to days. But once a yield curve occurs, it means that people are buying the shorter periods of time because they don't have confidence what's going to happen in America 30 years from now. So that's what's called the yield curve inversion. When short-term interest rates for short-term ventures pay more than long-term. It basically means people are scared of the long-term. The housing market is a definite aspect when it comes for economists to use the tools. The housing market has been growing. Again, I don't have that data, but I will have that for you shortly. So what causes inflation? Also, overheated economies, a black swan, which is an event that you really don't know it's coming, like COVID or something like that, or the Ukrainian war is a black swan. When you have a rise in unemployment, when demand slips, when there's shortages like what we're experiencing in the supply chain, money goes and sits on the side. Now, we're going to talk about the role the Federal Reserve System plays in recession. The Federal Reserve System is supposed to be is a central bank, which we're going to go into at some time in the future, explain what that is. But their role is they're the last source of lending. They're the Federal Reserve is their goal to be flexible and resilient with the economy. The goal of the Federal Reserve is to have stable money supply and is to protect the credit of America. And the system of the Federal Reserve as established today is basically to monitor the money supplies. Okay. Here are some current issues that I see on the horizon that might affect whether we go into recession. Obviously, we talked about the Ukrainian information, the China shutdown due to COVID uptick, the Ukrainian war we talked about. One other thing we need to talk about is something called butter and guns. When the U.S. economy spends more money and interest rates rise, that's less money for the government to spend on social aspects. So as recession comes and if the rates rise, that's going to be less money for social programs. Now, so let's talk about where we are right now. The consumer price index for March is at a 40-year high. Unemployment is 3.6% as of March 2022, which is really good. But the problem is, as inflation continues, people are going to start buying less, and when people buy less, less people work, less people get hired, and you get into a point that you have high unemployment and high inflation, which is stagflation. Goldman Sachs, April 11, 2022, marked that they expect there's a 40% chance of recession coming. JP Morgan, Jamie Dimon, who's one of the top financial people in the world, April 14th, predicts there's going to be a recession coming very soon. So take control and plan for your financial future. This is going to be a monthly element. It's going to be based on time, so I would suggest that you subscribe to it to make sure that you get the videos as they come out. If you have any questions or if things aren't quite clear to you, please put that in the box below. Again, it's important that you subscribe so you get the timely information. I'd like to thank you very much for your time and have a great day. Goodbye.